you to pay attention because this is the regulators, former and current. While the lights are very bright, we can still see you, and we have photographic memory. So when you come to apply for any kind of a banking on money transmitting and otherwise license, we will know who you are if you weren't paying attention. So welcome to our policy panel and discussion on fintechs, AI, stablecoins, and all things crypto. I have what I consider a very distinguished panel, but I didn't pick them out because they are distinguished. I picked them out because I need to prove to the world that former and current regulators have a sense of humor. And so the picking was very slim, and here they are. So I'll let you go down and introduce yourselves. I'm Yelena McWilliams. I'm currently president at Plaid. And most recently, I was the FDIC chairman, the good one. And we'll go from there.
And I'm Jeff Dinwoodie. It's great to be here. I'm a partner at Cravath, focusing on financial institutions regulation. Previously, I was at the SEC. I was the chief counsel to Jay Clayton when he was chairman. And then I headed up the Office of Financial Institutions at the U.S. Treasury Department.
Caroline?
Hi, I'm Caroline Pham. I am the CEO of Moonpay Institutional, and I also serve as Moonpay's Chief Legal Officer and Chief Administrative Officer. And I was previously the acting chairman of the CFTC, and before that, I was a managing director at Citigroup.
Alex?
Hi, everyone. Alex Lepore. I'm deputy to the chairman for policy at the FDIC. And to show that I am the only current regulator on the panel and that I do not have a sense of humor, I'm maybe the only person in this room with a tie on. Nice to be with you all.
And the views expressed herein are yours and yours only, and not those of the FDIC. I helped him out. All right, so we'll start. Our audience consists mostly of banks, fintechs, developers. Our customers, our clients and customers, we're B2B, they're B2C. In most cases. And so we have a number of different legislative vehicles moving through the Senate that affects what our audience does and the members in our audience. So maybe just briefly, let's go down and tell us, what's happening with the Genius Act, Stable Act, Clarity Act. That's a lot of clear, stable, genius acts. But let's just go down and tell us what are your opinions about what's going on with and any obstacles to their passage, and to the extent that some of them have passed into law, what is happening on the regulatory side?
So maybe I'll start and focus on crypto market structure, and that's the Clarity Act. And so the big picture here is we're making very good progress on the legislative front. There's been very good progress, including over the last 10 days or so. And so it's looking, cautiously promising. I think stepping back, and it's hard to predict whether it will be signed into law, and I think most people really hope it does, among other reasons, because this is such an important area. We need Congress to speak rather than the regulators making it up as they go along. I think when you look at the SEC, one way or the other, the SEC is truly going to have its hands full. If the legislation passes, the SEC over the next, frankly, 2 to 3 years is going to be under pressure working with the CFTC and other regulators to implement that legislation. I think in some ways reminiscent post-financial crisis of Dodd-Frank in terms of a significant amount of rulemaking. On the other hand, if it doesn't pass, I think the SEC arguably has even more work cut out for it in the sense that it needs to continue making progress on developing a workable crypto framework. But in some ways, it's a little bit more awkward for the SEC in working with the CFTC because they're doing so without that congressional directive. So I think the big picture is one way or the other, it's going to be a significant component of the SEC's agenda over the next 2 to 3 years. Caroline, I'm not sure if you want to cover that from the CFTC standpoint, but maybe I'll pass it to you.
Busy time in Washington. I feel like I left at the right time, so now I get to go over and build. And
it's always the right time to leave.
It's always the right time, right?
It's always the right time to leave.
Exactly. Oh, and Yelena, thank you so much for having me here, because your clients could potentially be Moonpay institutional clients, so please do feel free to come find me later. But at any rate, I think when you look at Washington and you look at what are the blockers or the hurdles, there's two, I think, that are really critical. And this is in the context of the Clarity Act, right? So number one, the calendar. There's just a limited number of days when Congress is in session to get through a very packed agenda, and that's without things popping up in various parts of the world. The other thing is that it is a midterms year. It is an election year, and so the narratives around campaigning, midterms, elections, all of that is also going to have a big impact on the Clarity Act, even if these narratives seem to not have much to do with the actual substance of the bill. So that's why I think the most optimistic and promising thing about what's happening in Washington, and we launched this effort last year when I served as acting CFTC chairman, but was that the agencies went full speed ahead to go ahead and start providing regulatory clarity, to change the regulation by enforcement policies, to stop discriminating against certain sectors, to put out staff guidance, which now we see this year is turning to rulemaking at the SEC and the CFTC, to basically harden this market structure, to scale it so you have adoption, because I truly believe that when you Uberize crypto, when you have a Bitcoin in every brokerage account, when you have tens of trillions of dollars a day on tokenized repo rails, you can't put that genie back in the bottle. So I think the future we are going towards, and what is being enabled right now in Washington with technology neutral policies, is one where you have an open architecture for payments and financial market infrastructure, and that's where you see blockchain rails, TradFi, and DeFi converging.
Alex, from a bank's and fintech's perspective, which of these acts matter the most, and what do you anticipate coming out?
Sure. So I will focus on the Genius Act. Unlike clarity and market structure legislation, where there is still some degree of uncertainty regarding the path forward, we know what the rules, generally speaking, will be for payment stablecoins. As this audience knows well, the Genius Act was enacted last summer, and over the last 10 months, the FDIC, the Treasury Department, the other bank regulators have spent a tremendous amount of time working on the rules to implement the statute. So our role at the FDIC is focused on our banks that wish to set up subsidiaries to issue payment stablecoins. We've been engaged in a rulemaking process over the last few months to make that framework a reality. We hope to issue something later this year that would finalize the rule set for our institutions. The OCC is doing the same thing for national banks, and the Fed is a bit further behind, but should be issuing a proposal in the coming weeks, coming months, that would set up the same type of framework for their entities. Now, for non-banks, they will follow whatever rules the OCC puts out, and so I would say the vast majority of the public market attention has been on the OCC's proposed rule set. There have been some discussions in Washington as part of the market structure legislation about whether the Genius Act's prohibitions on whether non-payment stablecoin issuers can pay some form of yield or rewards. Those discussions continue to evolve, but notwithstanding any result there, I think one thing is clear: there's a tremendous amount of interest in payment stablecoin issuance, both from a banking and fintech perspective.
Thank you. Maybe, Alex, we'll go back to you. Hot off the press this week, the White House issued an executive order on the skinny Fed master account. Of interest to a lot of folks in the audience, we know that it has been nearly impossible for a non-insured depository institution to obtain one of those coveted accounts. Can you tell us what is in that executive order, and where do you see obstacles in the implementation as intended?
Sure. So that executive order, which was issued less than 48 hours ago, so I
asked them to push it out before the
truly
conference.
hot off the press. It really fundamentally does two things, and the second of which is what Jelena briefly alluded to, which is on the master account side, and I'll discuss that in a moment. But the first thing that the executive order does, and this is really important and somewhat overlooked even in the initial days, it directs the banking agencies and the market regulators, the SEC and CFTC, to take a holistic view of their regulations, guidance, supervisory approach, no action letters, really the full universe of what regulators do, and to look for how any of those rules or regulations are impeding responsible innovation, impeding competition from non-bank entities, restricting bank-fintech partnerships, things like that. And so we have pretty tight timelines under that executive order to review our existing universe of rules and to come up with recommendations in conjunction with the administration on how exactly that rule set should be revised. The second thing that the executive order does is asks the Federal Reserve to take a hard look at how it provides services and accounts to fintech companies. Even hotter off the press than the executive order, the Fed actually yesterday put out a proposed rule that would do just that. It contemplates extending access to a broader range of institutions for what some have called a skinny account. So that process is well underway, and I would imagine that the Fed will accelerate its work as a result of the executive order.
That's great, thank you. I'm going to ask an unfair question, but I'm the moderator, so I can. The SEC, the current SEC, this administration's SEC you served in the last, thumbs up, thumbs down, how are they doing? Anything interesting coming out of the SEC? Anything we should be thinking about? Anything that the audience could be helpful with?
Look, I'll make 3 really quick points. The first one is just stepping back and what a change this SEC is from the prior administration. And when you just think about it from a common sense standpoint, okay, this is our government, an agency. It's not intended actually to be the nemesis or antagonistic towards business. If you go to any government agency or even a post office and you ask a question, you'd think the person on the other side would be trying to be helpful. And so there's just...
Did you say the post office? Okay, yeah.
Maybe bad example, but so number one is just a completely a change in tone and a breath of fresh air. Number two, and it's just a subtle point, is actually the chairman has put in place a team of leaders who have deep, deep experience in running businesses or advising businesses, as opposed to, and not picking on anyone in particular, as opposed to putting a bunch of academics in place. And I just think that makes all the difference in the world in terms of serving the business community, serving the investors in the country. The third point is just, and I have to give Caroline credit for this because she was really at the start of this. When you think about how our country is set up with these different agencies, it's actually very easy for them to operate independently and from one another and not coordinate, because that actually takes hard work. And a big thing, and I just can't underscore to the audience enough how important it is, and this has been a tone at the top from the SEC and the CFTC and frankly all the agencies, is we are working together, we are coordinating. And it's really that cultural impetus, it's just been so valuable. And again, you started that and it's carrying on, so kudos to you.
One team, one dream.
Aw, that's actually very cute. Well, one team, one dream. How about this, the CFTC, Caroline? You left recently, so if the question is too soon, then you don't have to answer. We'll go to Alex. But if it's not too soon, how is the CFTC doing? Are you pleased with how they're moving along? Any ups, downs that you foresee in the implementation of the president's agenda?
So one of the things that is so refreshing about the administration, I'm going to echo what Jeff said, is that it took a very pragmatic approach to how we should be regulating our markets, and not forgetting that our markets, especially our capital markets, are there to help promote and grow the U.S. economy, right? It's to help to create jobs, it's to help to lift up all Americans and to provide access to the opportunities and the benefits of why we come here for the American dream. And we're here celebrating America's 250. So at the CFTC, it was so important for me to not only make America the crypto capital of the world. I'm really good at following directions. That was the direction. We went for it. We set the milestones. We launched the crypto sprint. And so with the crypto sprint, working together with the SEC's Project Crypto, you had the first ever spot crypto trading on CFTC exchanges. You had the tokenized collateral and stablecoins guidance, which I think is really going to transform capital efficiency for our markets. We did a digital assets pilot program. The thing that we didn't get a chance to do, which was sort of the next phase of the crypto sprint, and one that I really appreciate that CFTC Chairman Seelig is really moving forward on, is recognizing blockchain as infrastructure for financial markets and making sure that our rules are actually technology neutral and it's not being penalized if you want to do things like have on-chain execution, on-chain settlement. That's how we modernize and make more efficient our financial system. So that's something I'm really pleased that they're continuing to work on.
Thank you. Alex, I could ask you a tricky question and say, how is the FDIC doing, thumbs up or thumbs down? But you may get fired before your train arrives in Washington, D.C. if you're perhaps too honest. So I will ask you a softball question. It's not really a softball. We have seen in the last administration how much the regulations have impact on the bank-fintech partnerships. We have a number of fintechs here, a number of banks who have either found themselves on the sponsor bank side or on the fintech third-party service provider side. And we have seen a number of consent orders come out in the last administration, et cetera. How is the FDIC, this FDIC, approaching innovation? How is it looking at third-party partnerships? And how is it, what's its view on the fintechs partnering up with banks?
Sure. I would say from the first day that Chairman Hill took over, bank-fintech partnerships and fostering innovation more broadly have just been critical priorities, and we've executed those on a number of fronts. But I guess just taking a step back, the principles that we're working toward here, I want to pick up on something that Caroline said, which is technological neutrality. That has been a guiding principle. A second principle is something that Jelena mentioned, which is ending an enforcement-first approach to regulation. And then a third principle is just allowing banks to meet their customers and their communities where they are. And that often involves the provision of financial services with or through fintech companies. And so I guess taking those principles, what does that mean in practice? Well, as part of our implementing rule for the Genius Act, we proposed something very narrow, but we think very important, which is to clarify that tokenized deposits, so a deposit liability, using distributed ledger technology to record that liability should be treated no differently than any other deposit. Seemed like a fairly straightforward thing, but there was a lot of ambiguity, and so we're looking for areas like that to provide that type of clarity. A second example on the regulation by enforcement approach and how we've ended that, under the prior administration, there were dozens of consent orders that banks and their fintech partners were forced to parse through to sort of discern what the real rule set was. We've ended that approach and have provided ex-ante clarity so that folks know what the rules of the game are before they go in. And so that continues to be a big priority for the chairman, and we're looking for every opportunity to provide clarity up front.
Oh, I think you should provide your personal cell phone number to the audience, just in case that's not the case and they know whom to call. All right, last question. We can't have an AI conference without asking you a question about how is Washington and the regulatory agencies that you're affiliated with or were affiliated with, how are they looking at AI, and where do you anticipate developments going in the next couple of years?
I'll say something that's intentionally provocative for a second, which is, about 3 years ago, SEC Chairman Gary Gensler was exactly right on the idea of starting to think through how are financial institutions utilizing AI. So that concept was correct. Of course, the execution of that was completely wrong in terms of rather than learning about it, just going out with a ham-handed proposal to regulate it in a way that doesn't make sense. And so my big picture is that regulators need to be continuing to lean in, learn, look out the windshield instead of in the rearview mirror, and continue to learn about AI. I think it's only good for the industry, for the SEC, the CFTC, and the banking regulators to continually learn about it and understand what are the risks. That's how we get good policy, when it's over a deliberative, thoughtful approach rather than doing something knee-jerk. And so big picture, I know they're looking at it and encourage them to continue to do so and learn about it.
Thank you. Caroline?
So one of the reasons why I was excited to come to Moonpay is because Moonpay's DNA is really as a fintech payments provider. And I came from Citi, I came from the banking and fintech space, and so AI is not new. AI has been used by banks for at least 10 years. I started working on AI risk governance frameworks when I was at Citi in 2018. And so one of the challenges for the market regulators like the CFTC is that they need to catch up to the bank regulators with sort of the expertise, the familiarity, and the application of risk governance frameworks to AI, which is essentially a very fancy model. model risk management is so important. So I do think that one of the challenges is understanding how you take those risk governance frameworks, those different risk stripes, how you use AI within that. But I do think it generally falls into two different categories. So having a flexible, principles-based approach to, generally speaking, the use of AI in your financial products and services is key. That's really no different from how you think about operational risk management, model risk management, all of those different things. Where I think it may make sense for an agency to be more prescriptive is when it comes to market integrity or market conduct risk. That's where you want to have protections for clients or customers or investors. You want to have disclosures. You want people to understand when they're interacting with an AI versus when they're interacting with a human. You want to make sure that there are those guardrails in place, particularly when it comes around providing advisory services and things like that. So generally speaking, risk governance frameworks are very important. When it comes to market integrity or market conduct, perhaps a more rules-based regime is appropriate.
Alex, you have a final word.
Yeah, so I completely agree with the way that Caroline characterized that, and maybe to just pick up on where she left off, we recently updated guidance on model risk management to recognize the world as it is, and that is a world that includes generative AI. So we're looking, as we see our banks experimenting with AI, using it both for internal efficiency and to meet customer needs, we're looking to meet them where they are. I would say that the bigger challenge for us is using AI as an agency. I think almost by definition, government agencies will be a little bit slower than the private sector to adopt new technologies, but that is a big priority for the chairman, and we are moving fast, relatively speaking, to try to catch up to where the private sector is. But candidly, that is probably a place where we will struggle more than the private sector will.
Thank you all. Thank you for being here with us and sharing your thoughts. And to the audience, thank you for giving us your time.
Thank you.